Welcome to my channel again. I'll have episodes about stocks, clarinets, saxophones, finances, investments like this episode, and other subjects to ramble about. Today's episode is about those P2P or person-to-person loans managed by online vendors. Of course, don't forget to subscribe and like afterwards. What I try to do on this channel is to help you see what critical things to look at and learn more about all the how and what about investments. So I hope you learned something today. I certainly did. So, what is it like being an investor of person to person loans or peer to peer, P2P? Or have you ever heard of those companies that do person to person loans? Because years ago, I really wanted to invest in P2P secure loans. Secured loans is where there's an asset related to the loan, such as a car loan or other vehicle loan. Then, if the loan goes south, one can confiscate the asset, then sell the asset to recover the monies the debtor owes, and hopefully the debtor will then be liable for the variance of the debt and the auction price. But with a large overhead, you have to deal with that liability and that secured loan. But it's more secured, and hopefully you don't lose everything if the loan goes south. But I couldn't find any real P2P secured investor options out there, just unsecured P2P online loan vendors. Companies will sell this concept as an alternative to a savings account. There's places out there like Prosper, Lending Tree, Perform, Upstart. There's others out there too. My experience really is one of neutrality in a way. We'll talk about that more in a few minutes. But after about 5 years, I eked out a 1.53% profit. Yes, you heard that right. 1.53%. Is it worth it? To me, no, not at all. But your experience may be different. Now, I got out of that about 2 years ago, and I started probably, I think, in early 2016 or 15. I don't really remember why or when actually. But how and why do these actually work? Well, let's get to that in a moment here. So, person to person loan companies, this is my investment analysis and personal opinion. These are all possible P2P companies out there. This is from Investopedia, as you can see. You got Perform, Lending Club, Upstart, Prosper, Funding Circle, Payoff. And you can look what they're best for, type of credit history, the APR range they give, 30%, 36%, all this stuff. That's where you can get returned, assuming it doesn't default on you. Minimum loan amount, maximum loan amount, terms they have, recommended credit score. Now, this is interesting. Recommended credit score. Is this the FICO credit score or their calculated credit score? Because really, when I looked at some of these loans, I'm like, there's no way this can have a FICO score of 640. More like a FICO score of 400 or 300, I thought in some cases. So really interesting. The type of loans out there they give to people are like debt consolidation, home improvement, large purchases, medical, dental, household expenses, vacation, a variety of other types. Now, briefly, a P2P loan is if I wanted to get a loan of $100, that means, let's say there's a minimum $25 investment a piece. That means 4 people had to invest in that. So basically, if you use a $25 investment, you could always do more, of course, and there's a $4,000 loan out there, it would require 160 people to invest in it. Then that loan requester gets the amount within a certain time period they can get the loan. If within, say, 30 days, you don't get 160 people to invest in it, but you get above a certain percentage, like 70%, the loan can get approved and it'll stay open. But there's some loans that don't meet the requirements and get canceled. Some that simply get canceled by the requester. All normal things. The problem is I created a small model of a distributed risk and it failed. It failed amongst every segment that I deemed worthwhile. As you saw on that other screen there, you could do a 3 or 5 year loan. I only did 3 years because I knew people were going to be horrible loans and I knew there'd be a higher percentage of 5-year defaults. So I went with 3 years. There's also a option you had of selling those loans. But as I got into it and I got to the point I wanted to sell it, there was really certain requirements that, well, really no one wanted to buy those loans. My strategy was to sell loans after a year and a half because then the probability of it going default went much higher. But the trouble is, no one would buy a loan unless it was an A plus, A double A, or something like that. And then they all wanted it after you bought it because they don't want to deal with it a year and a half later. Like I was in the sketch 22, it's like, oh, my strategy isn't working. And I'm kind of stuck now with these loans for 3 years. Luckily, I did not do any 5-year loan. They were all 3-year loan. And even though there are grades of A plus, double A, B, C, D, E, F grades, I stuck with the better ones, which meant I didn't get as good as return. I didn't get the 35% that we saw in that one screen there, right here, up to 35%, because I wanted it to get paid off. The higher the percentage, the higher probability it'll go in default. So that means the less time you have to break even. And that's the problem that I saw with the risk model. And I was dead on. As I told you before, my return on this was 1.53% over like 5 years. It wasn't worth it. Of course, these are the type of loans, as I mentioned. The other identifiers that are important are the vendor score, which is a calculation similar to a credit score. But today I see they all are also including credit scores, and there's a bunch of other varieties. For instance, here's a particular screen. Before COVID, there was ratings, like I mentioned, up to E, F, or worse. But when I checked it today to do the screen, there was no rating below a C. So I'm guessing anyone below a C, you're just playing out of luck. And of course, the interest rates now are much higher than what I remember them being. See this A one, which is debt consolidation. We can see here the first one, amount 12,000, 9.99%. To me, I would skip this. What I was looking for is I was looking for a low loan amount and either debt consolidation or medical. And this next screen I'm going to show you, you'll see why. Because I wanted to give the monthly payment to be low and affordable based upon what I thought the risk was. See these other ones, home improvement, $5,000 for 23.49%. That's a lot. Here's a double A debt consolidation, $12,000 at 5.3%. That one I may take, even though it's not a very good return. Versus the home improvement, $10,000 for 14.24%. You know, there's equity loans out there you can get for your house that are a far better option because you can write that off in taxes, assuming when you get an equity loan and you use the money towards your house, you can write off in taxes. If you use it for other things, I don't think you can write it off as taxes, but you may want to check your accountant for that or your tax preparer. But you can see the differences here. You know, a C is 20.25%, an A is 9.75%, a B is 12.8%, a double A is 9.69%. There's a D sitting here for 23.49%. And these are some examples of the loan categories. Here's one of the screens that you can able to look at. And this is one of mine from years ago. You can see from 2016, I pulled it up. Verification stage, borrow state, Texas, borrow rate 8.51%, monthly payment $568.30. This is one thing is when you look at in one of the screens that had the range of their income and the range of their current debt, I didn't want their monthly payment to be so high that they have no money to do anything else. That's one reason they're here. I think they're in the really high risk category where the banks are ignoring them. Credit cards would be too high. Personal loans from banks or credit unions would be too high. And they're here. So this is a high risk organization with higher risk people. Of course, there's this servicing fee. You always have to watch for that because if someone's late for a monthly fee, you'll get a servicing fee in addition to this for them to do collections on them. Of course, they could go into collections. They could sell off the debt to another collections company. You never know. There's plenty of ways of losing your investment into this. If you look on the right, effective yield, 7.6%, estimated loss, 2.7%, estimated return, 4.8%. So they've already calculated a potential risk of losing this your investment. And we're at 4.8% now from 8.51%. So we're already not doing very well here. Here's an example of a double A. This verification stage, they go through different stages of verification. Borrow rate 10.69%, monthly payment $118.73. See, this is a good one. A low monthly payment, a high probability of paying it off, which is good. Gives you the amount, a low amount, 5 years. I would never touch a 5-year one though. I'd probably go for 3-year. Historical return. Well, this one's from Prosper, actually. Rating AA. A score of 11. FICO range is 780 to 799. I don't know how accurate these numbers are because I must have bad luck with my strategy, but I would never have guessed someone would have a 780 range and then default, you know. But it goes through and shows you total credit lines that people have. Current open credit lines, first credit line, 2003. So if the first credit line is 2003, let's say they were 20 years old, that means they're about 37 years old right now, 40 years old or something like that. Current bank card utilization, 6%. Has a mortgage, yes. Debt to income ratio, 21%. Employed, state income of 100,000 plus. And delinquencies, 1 in the past 7 years. This is what's interesting, is 6% bank utilization. I wish it showed what the monthly mortgage was, because they have a really good income. Do they have kids? It doesn't say stuff like that. It's like, why do they need this money with the income and the credit card balance is 18,000? I can see where that's a problem, but that's not for this loan. This is a $5,500 loan. It kind of doesn't, it doesn't really add up. But, hey, historical return 3.4% to 5.2%. I always thought I was reading this wrong, but in the end, I was like, you know what? I was reading things right. It wasn't a very good risk. Here's another example. Another one, state of Michigan, borrow rate 24.49%, $5,000, 5 years. Credit profile, Prosper rating of 4 up to 11. FICO range of 680. Really? How do they get a Prosper rating of 4 instead of a FICO range of 680? That doesn't make any sense. First credit line of 82. So it was 38 years ago. You assume they're about 20 years old there. So it's 58 years old. Revolving credit balance, 6,300. Bank utilization, 90%. Okay. So their income isn't very much because the credit card companies won't give them much. And with the credit card companies today, charging you 30% basically, they'll give you $7,000. Multiple credit cards, you'll have $14,000. Here, they don't have it. They have $6,300 in credit card balance, 90% utilization, has a mortgage, don't know how much it is. They've apparently inquired for some type of loan once in the past 6 months. Debt to income ratio 32%, employed, income range 50 to 75, occupation other. I don't really know what that means, but I can see why it's a D. There's something fishy here. You can't get credit. Doesn't make that much income. He makes enough. He actually makes more than what I make if he's in that range. Interesting, huh? Excluding, finance, the stock market. But it comes out with a D, which is where I would put it because the numbers here don't really make sense, but they don't give enough information here. I would love to see the credit report. But actually, I probably wouldn't touch this as a 5-year, first of all, but I just pulled this out as an example. Historical return, 3% to 11%, 3%. This is one where you hope they pay off past the break-even point before they are delinquent. But are these good investments? That's what we're here to talk about. You got to remember, you're locked into a 3 or 5 year agreement. You're locked in, you can't get out. I've tried. There's so many hoops you got to jump through, you can't get out of it. I just kind of gave up. Like, okay, I'll play the game. I'll just do 3 year loans. I'll look for A or B's. But there's still people just are horrible to loan money to. Everyone defaults at one point. I mean, you can only hope the lender pays it off early and hope that they make their monthly payments on time. Otherwise, they go and you get a late fee because you're paying a late fee because you're paying the company money to follow up with the person you loan the money to, and they charge you a fee. And then they charge all the people that invest into it a fee. So they're making a ton of money off of this. You got to hope that they don't default on it either. You got to hope the online vendor doesn't sell it to a collector. I mean, there's so many pitfalls. For me, I found it a bit too unstable of an investment for me. Are there better options? There's actually many. Find a mutual fund with a great return. Check year to date, 1 year, 3 year, 5 year returns. Because with a mutual fund, you can add withdrawal at any time, assuming you get a good online vendor. As an example, and I'm not sponsored by them, but I use Fidelity primarily. I have other accounts with E-Trade, Ally Bank. I forgot a couple others too, but I really like Fidelity. You buy into their mutual funds, you don't get charged a fee. At least I don't. No transaction fee, nothing. It's great. You can look at a high yield bond, which is like a mutual fund, just a high yield bond you get with your mutual fund company. More stable, have a guaranteed return. You get 6-8% on that. Of course, you can use a savings account. Nowadays, of course, the interest rate for savings account is like 0.05. But my credit union came up with a savings builder thing recently where I get basically 0.95% of my money, which isn't bad for a savings account. And I use that as this reserve funds for my checking account. So for me, there's too many possible problems as people are just simply bad debtors. This is what I learned from this. You've probably heard also never loan money to friends or family as you'll never get it back. You know, I love to find out what these true statistics are of these type of loans going bad. And if you've ever loaned money to family or friends, have you ever gotten it back? Just kind of write it off, right? So here we are. That's my example of a P2P loan company, online vendor, whatever you want to call it. My recommendation, go get a mutual fund, get an S&P 500 mutual fund, a NASDAQ mutual fund, something else. I went down this road, see if I can make more money than I could. And I'm always looking for ways of making more money with stable investments, low risk. And this just didn't fit the bill for me. Okay, that's my opinion. But anyways, thank you for listening to my ramblings. Questions or comments, just put them down below. Don't forget to give a thumbs up, subscribe, and like, and comment, because you gotta love the knowledge, you gotta love life, and you gotta love investments. We'll see you next time.